to the owners of companies, right? So it is only the owners of those companies who are benefiting from those dividends. The question is, do we have access to it as members of the public? And the answer is, for majority of those companies, yes, because they are listed on a public stock exchange, which is the Nairobi Stock Exchange or the Nairobi Securities Exchange, as it is known today. So this is answering the question of why buy shares. We can participate in the profitability of the companies who are making a profit from us as individuals. Every time we'll go out to have a drink, we'll be making EABL some money. Every time we're talking on our phones, we're making Safaricom some money. Anytime we put fuel in our tanks, we're making Total some money. Anytime we do a transaction at the bank, we are making the KCBs and the equities some money. So there is no good reason why we should always be on the side that is being the customers and providing the profits to these companies, when there we can also be on the flip side and on the other side of the coin, where we can be the beneficiaries of the profits that these companies are making in form of dividends. We can also be the beneficiaries of the increase in value of these companies over time. Because as companies grow and become more profitable over time, the consequence is that there is an increase in the value of those companies. So again, the only people benefiting from that are the people who own these shares, and these shares are readily accessible to us as members of the public, because we can simply go to a stockbroker and buy a lot of these shares. So why buy shares? For those reasons, and the reasons that you guys stated very well, right? So please make the Nairobi Securities Exchange your best friend. Go to their website, get to understand more about them, get to understand more about quoted securities through the ShareHub platform. We had Linda telling us that they will be in a position to offer us a lot of information for long periods of time, 10 years of historical data. So please make those your best friend, because it is only through being informed that you are able to participate in the opportunities that are there, ladies and gentlemen. These are not hidden, they are not exclusive, they are all there for us, but we have to walk through the door and take advantage of them, right? Now, what we've been talking about are shares that are listed on the stock exchange, or securities exchange rather, as it is now known. But, and I believe ShareHub in the future, being a very innovative platform, will also provide us access to shares of companies that are not yet quoted. So there are a few companies in our market today whose shares are not traded on the securities exchange, but whose you can also buy, and they are called unquoted shares. A few of those examples are Family Bank. Another example may be UAP, Old Mutual Insurance Group. Another example may be the Aecon Real Estate Group, who are responsible for the well-known brand, new well-known brand in our market called Kwetu Housing, that provides student hostels. So those are examples of unquoted shares that you can also have a platform to, you can also be in a position to go and buy. And like I say, I'm sure ShareHub, being a very innovative player in the industry, will be in a position in the very near future to give you access to unquoted shares as well. So again, even as you hear about all the investment opportunities out there, and the reality is when you go out into the market, you'll hear about land and real estate, you will hear about government treasury bills and bonds, you will hear about cryptocurrency, you will hear about trading in foreign exchange. Remember, you have access to a platform that is very easy and with very small entry amounts to some of the most profitable institutions in our economy. These are the businesses that have weathered the storm over many decades with very good and sound business models that have allowed them to to be able to ride the storm of rough patches in our economy, COVID being one of them, the war in Russia, Ukraine being another, the global recession of 2008 to 2010 being another, the post-election violence that we unfortunately had in 2000 being another. So a lot of these companies that we're talking about have been there from the 60s and the 70s and the 80s. So they've been there for 20, 30, 40, 50 years, have sound business models. So there again, it's just to reiterate, ladies and gentlemen, you have the opportunity to take advantage and stake a claim of ownership. A lot of these other asset classes we're talking about may have capital considerations in terms of big amounts of capital that are needed before you can invest in them. The stock market or ShareHub and a lot of the products I know they're going to launch will enable you access with very minimal entry amounts. So take advantage of it as much as possible. Paris, if there's any burning question there I can answer, I am open for 1 or 2 questions as we move along.
We have 3 questions.
Yes.
The first question, I'll pose it to Linda. And the second and the third one, you will take the questions, because the third one you've addressed it. The second one you've addressed it in a way.
Okay.
The first question to Linda, I'll fill the questions and then I'll give you a chance for both of you to respond. The first one is, how do you know when there's a sale of bonds? How do you know when there's a sale of bonds? The second question to you, Motho, is what is the minimum amount I should have to start trading on NSE? And the third one is, are there companies on stock exchange that pay dividends monthly? We will take the rest of the questions as we continue. Please respond to the 3. We'll start with you, Linda.
Okay, thank you, Paris. So sale of bonds. Now, if it's, there are 2 markets when it comes to the bond market. There are two markets when it comes. There's a primary market and the secondary market. This would be a whole session, but just in brief, in the primary market, this would be CBK normally float bonds on a monthly basis. If you go on the CBK website, you'd be able to see which bonds are on offer for the month. When it comes to the secondary market and you're looking to buy a bond, then you would approach a broker with whichever bond you're interested in buying, if it's an IFB, and then they would try to source for a seller for that, and then be able to match those trades. But on a monthly basis, CBK does post the bonds that they have on offer, so you can look at their website and you'll be able to get all the details. They normally share a prospectus of the bond with all the details with it, and now you can use that to be able to know which bond to invest in.
Thank you, Linda. I'll ask you, Motho, to take the other 2 questions.
Okay, thank you, Paris, and thank you for those questions. Now, in terms of a minimum amount you need to invest, there is no set minimum amount. What is set in terms of a minimum is the number of shares that you can buy in a particular company. So at the moment, the minimum number you can buy is 100. So the amount that you need is now dependent on the price of the share that you're buying. So for instance, if Safaricom today was trading at a price of 18 shillings per share, and you can only buy a minimum of 100, then that means what you need is 1,800 to buy those 100 shares. But for instance, if you wanted to buy 100 shares of BAT, and it was today trading at a price of 460 shillings a share, then to buy the minimum of 100 shares, you need 46,000 shillings. So what is stated as a minimum is the number of shares that you can buy. But again, I think I would like to reiterate here and hold on to this space that ShareHub is looking at, again, being innovative and coming up with a product where you can even put even smaller amounts than that. So I do believe that they will be communicating in due course with regards to that. Now, with regards to the question of a monthly dividend, there are no companies that pay dividend on a monthly basis. The most frequent dividend payers on the stock exchange pay dividend twice a year. And dividend is a factor of profitability, which is not an absolute guarantee in all situations. So making a profit in any particular year is not an absolute guarantee. But the most consistent dividend payers have been paying dividend on average twice a year. I would say the most consistent dividend payers in our market would be the likes of BAT, would be the likes of EABL, would be the likes of Standard Chartered Bank. Those companies that, again, I said, are solid, have been in this market for the last 30, 40, 50 years, have had good business strategies, and to a small extent are nearing a maturity phase where they can afford to give a lot of their profits back to their shareholders in terms of dividends. There are other companies that even make more profits than the ones that I have stated, like for instance, Equity Bank, but they'll only pay dividend once a year, and the amount of dividend they'll pay is likely to be even less as a percentage of their profits. And this is predominantly because Equity Bank is still in a phase of rapid growth. They're in a phase of now looking outside the borders of Kenya and have been very active in the likes of East and Central Africa with the likes of Rwanda, Burundi. They've made a big acquisition in the Democratic Republic of Congo. So because of that, they need a lot of the profits that they are making for that expansion. So they cannot afford to pay too much in dividends, and a lot of times only pay dividends once a year. But maybe in 10, 20 years in the future, once they reach a higher stage of maturity of the growth of the company, they'll be in a position to pay more. So again, as a sum up to that, no, there are no companies that pay dividends on a monthly basis. The most frequent dividend payers pay twice a year, usually every 6 months, at half year and at full year. And please remember again, dividends are not an absolute guarantee. So I think we'll move on from there. And if there are any further questions on that, we can look to have them later on in the session. Let me try and move to the next slide. So we were here to discuss building an investment portfolio. But before we talk about how to build and manage your investment portfolio, the question is, what is a portfolio? Do we all understand what is a portfolio? And again, through Paris, could we please give some answers in terms of our understanding of what a portfolio is, to see what our basic understanding is? Paris, 1 or 2 answers on that, tafadhali. What is a portfolio?
I'm waiting for the chats. Please engage us. Yes. We have Maureen Mwendwa saying diversification of investment. Onyango saying range of investments. We have those 2 so far.
Okay, those are good, very good attempts. Diversification and a range of investments. Yes, that is what a portfolio is. A portfolio is basically a basket or a collection of assets that you hold. So it's basically a basket or a collection of assets that you hold. The next question is, are there alternatives? And the answer is yes. One could choose to invest all their funds in one single asset. Again, I repeat, the answer to whether there are alternatives to a portfolio is yes. One could choose to put all their financial resources into one specific investment. So the question is, what are the pros and cons to have or not to have a portfolio? Let us start with the alternative that we talked about, which is putting all your eggs in one basket, or which is concentrating all your financial resources in one particular security. And let's give a few examples. If we put all our funds in the Safaricom IPO in the year 2008, when it came to the IPO, what would have happened? If we put all our funds in 2008, in 2010, all our funds 2010 to about 2013, 14, all our funds would have been trading in negative territory. That is because with trading of Safaricom, there was an initial spike in the first few months, then there was a depression. The share IPO'd at 5 shillings a share, shot up to about 7 shillings 90 cents at a peak, and in the next 1 to 2 years, touched a very low of 1 shilling and 90 cents. So had you concentrated all your funds in Safaricom as a single investment or put all your eggs in that basket, 3 years later, you might have been crying all the way to the bank, right? However, Safaricom did a U-turn, and at its peak in the year 2021 and very, very early 2022, touched a high of 44 shillings a share. Remember, from an initial share price of 5 shillings a share, not to mention, and here we're talking about capital appreciation, not to mention that every single year since listing on the stock exchange, Safaricom has paid some sort of a dividend as further compounding of the return that you've made. So had you held those shares for this long, again, instead of crying all the way to the bank, you'd be smiling all the way to the bank. But that risk is big. And that is, so there's a potential pro to putting all your eggs in that basket, in the sense that should it work out, it can work out spectacularly well. But should it not work, it can also fail spectacularly. And from our little experience in the markets, there are more situations of where things have not worked out than where things have worked out. Hence, we stress the issue of diversification, and I think that was mentioned by Maureen, and maybe that is even another term that I should have put here. And diversification being the spreading of your eggs or the spreading of your resources amongst different assets to ensure that you're catering for risk, so that if one goes down and another goes up, you are hopefully in a net position where you're going up. So the pros, like we said, of holding all your eggs in one basket is that should it work well, another example, even if we give examples of internationally, had you bought shares of the likes of Amazon or Apple in the year 2000, they might have worked out spectacularly well. But for every Amazon and Apple, there are 10 other examples that have not worked well. Right? So I'm already speaking about the pros and cons of the portfolio, and the main pros of the portfolio is what we talked about in terms of diversification, in terms of having a range of assets, so that when the Safaricom share was going down towards 1 shilling 90 cents, and you had some shares in BAT as well in your portfolio, and you had some shares in EABL, those were going up. And when Safaricom at that point in time was not paying that much in dividend, I believe in the first few years, Safaricom was only paying 20 cents a share in terms of dividends, whereas the likes of BAT and EABL were paying 10, 15, 20 shillings a share in terms of dividends. So as the Safaricom was going down, these others were going up. A prime example of the beauty of diversification of the portfolio today, over the last 4 or 5 months, again, Safaricom has been going down due to a lot of issues that are not specific to Safaricom, but are global issues. So over the last 1 year, it has gone down from a high of about 43 to the low that we're talking about of about 18 shillings. But in that time period, Standard Chartered Bank has gone up from 120 shillings a share to about 170 shillings a share, right? So that is the beauty of diversification. So those are the pros and cons. And as general advice, the advice is generally to diversify your portfolio where possible. However, and this is something that I think is important to note, when you are starting out as a small investor, do not diversify too much. It does not make sense to aspire to have small quantities, very, very small quantities of 30 different shares. It's necessary to diversify, but to a limited extent, where you're having maybe 3, 4, 5 different good shares. that have enabled you to diversify and not have all your eggs in one basket. But the flip side is that when we go, when we make it too excessive in terms of our diversification in holding too many shares, then what happens is when we have too few units of any share, even if the price goes up in a very good way, we are not able to benefit from the shilling amount of gain since we had very, very few shares. So give an example of the same Safaricom today. If we are buying those, if we're buying at that 18 shillings and we only buy 100 shares, so we only have 100 shares of Safaricom, and then it goes back up to the price that it had come down from, which is about 43 shillings, which is an appreciation of 25 shillings, then we only make 2,500 because we only had 100 shares. However, if we had concentrated, and we were doing that because we wanted to have 10 other shares that we are buying. However, if we concentrated and we said we're only concentrating on 3 or 4 shares on the securities exchange, and then we were able to buy, because of that concentration, we were able to buy 1,000 shares of Safaricom, then it went up from the same 18 shillings to 43. We, instead of making 2,500 when we had 100 shares, we would now be making 25,000 in profit from the 1,000 shares. So again, what's the take home from that? Diversification and building a portfolio is good, but when you are a small investor, avoid excess diversification because it dilutes the potential gains that you can make. Paris, I can open up the floor to any burning questions. We'll be answering 3 questions, 3 burning questions. Then the rest we will have at the final Q&A.
Thank you for those very, very key points on diversification. We have a couple of questions, but I'll take one from Muya Austin. Is there an advisable percentage of asset allocation to a stock, debt, money market, and other alternative investment options? I repeat the question. Is there an advisable percentage of asset allocation to a stock, to debt, money market, and other alternative investment options?
Thank you for that good question, Austin. The reality is there is no absolute figure that one can advise with respect to what absolute percentages you should allocate. What I would say is, as a beginner investor, based on the funds that you have, look at having a maximum of maybe 5 shares and allocating equally amongst the 5 shares. And as you then start to grow and start to digest information with regards to those specific companies, you are then in a position to see, and you're doing that with also the combined discussion with a reputable financial and investment advisor. You're then in a position to start seeing whether you should maintain them at an equal level or whether you should start to look at concentrating in some and reducing others. Also, there will be market information that is coming up that will be causing you to change the different proportions that you are having with the different shares. So what I'd say is, as a beginner investor, if you are starting by buying 100 shares of each company, because remember we said 100 is the minimum, start by buying an equal portion of each. And so buy 100 of each and look at 5 good companies and buy 100 of each. Thereafter, as you are digesting information and as you are becoming a more astute investor and you're starting to understand and to digest information with a better understanding, you're then able to see whether you can maintain at equal amounts or you can start increasing the proportion of 2 of them or 3 of them or 1 of them, depending on the market information that is coming out there. If I can give you the example of the person who is widely known as the most gifted investor of our time, who is called Warren Buffett, who has a portfolio which is in the hundreds of billions of dollars. That portfolio is spread amongst about 50 companies, but the concentration of that portfolio is, there may be 50 companies, but more than 50 to 60% of the concentration is within 10 of those 50 companies, right? So there is no one size fits all, and there is no absolute recommended portfolio holding in terms of distribution. It's simply based on what are the opportunities and what are the companies out there, and what is the information that is being released on those companies that determines whether you should be buying more of those companies or selling. Question number 2, Paris?
Yes, we have, Felix will take your question at the end because it diversifies a bit. We have Martha. Martha is asking, when do you know it's time to exit instead of holding on? For example, Safaricom shares. Then an anonymous attendee has said, you have said good companies. Are there fundamentals to look at to gauge this? If I want you to guide me, will you be available to take me through, and what will you need to help me attain my financial goals?
Okay, thank you for those 2 questions. The first one was by Martha. Please, sorry, Paris, just repeat that first one slightly.
When do you know it's time to exit
Yes.
instead of holding on?
Okay, that's a very good question. Again, there is no fixed answer to that question. When it comes to the stock market, everyone has their strategy when entering the stock market and when trading in the stock market. What is important, I think, to note is that a lot of times people fail to get out because of greed, right? So you see a share going up and you think it can continue going up indefinitely. And you want to hold out for the next shilling and the next shilling and the next shilling. And when it does a U-turn and starts going down, you are unable to sell. So I think what is important is to look at the fundamentals. Now, I believe you guys had a class with Abodzani last week where you started touching on the fundamentals of companies and what those fundamentals say in terms of whether you should be buying a company or not. So one of the things to look at are the fundamentals of companies. Another thing is to also possibly come up with your own trading strategy. So an example of a strategy could be when a company has appreciated 30%, you will sell, irrespective of whether there's going to be continuous appreciation or not. And you will only buy when a company has depreciated 30% or 40% or 50%. So Martha, just to again reiterate that there is no one fixed answer to those questions. The issue is, number one, do not get greedy. As you start to trade, start to formulate a few of your own strategies. And number three, Abodzani opened the door with regards to reading the fundamentals of companies. So it is upon you guys, with our help, of course, here at ShareHub and other institutions out there, to continue to sharpen your knowledge about what do the fundamentals of companies say in terms of the share price. So if you look at the fundamentals of Safaricom today, probably what you're going to see is that the share should be priced at 30 shillings or 35 shillings. So you know when it is trading at 18 shillings, it is undervalued and you should be buying the share. So if the share, if the fundamentals are saying also it should be priced at 35, then it goes to 50, you know it is overvalued and you should be selling while you still have the opportunity before it comes down, right? So again, for the purposes of this session, that's what I can tell you, that is that you can formulate your own strategies, number one. Number two, do not get greedy. And number three, make continuous efforts, even after this class, to start to get to understand reading of fundamentals based on what Abodzani presented to us last month, to start to continue to read fundamentals and what they say about share price, because the fundamentals of all companies will tell you that companies should be priced at a certain amount. So if the fundamentals are telling you one thing and you go into the market and you see the market is telling you another thing, then you're in a position to know whether you should buy or sell based on now what they are saying. Now, the other question in terms of identifying good companies and whether one can get assistance in understanding what are the good companies out there. Yes, that is a conversation. What I would say with regards to that is get in touch with ShareHub after this session and understand the extent to which they can help you, and then now they can transfer you on to me with regards to any sort of assistance that one can get with regards to that. But the help and assistance is out there. Like we are saying here, we are opening the door for you. Please walk through the door, and we are here ready to assist you. So please take it up with us after this session. I think I want to move from there, Paris, then we can handle more after we are done. If you'll allow me.
I have only one question. I have one question for Linda.
Yes, Linda. Yes.
It's 4 questions that I wanted to bundle up together because they are related.
Okay.
They're from Kevin and Dominic and an anonymous person.
Okay.
So on how do you choose the right stockbroker and the requirements and steps for opening a CDS account?
Okay. How do you choose the right stockbroker? In my opinion, a lot of times in this day and age, in the society that we live in, referral is a very important tool. So ask people out there what, if any, experiences they have had with specific brokers, and you'll start to get an understanding of who people prefer to work with. It may not even be an issue of whether the broker is financially sound or not. It may be an issue of the kind of services that they offer. It may be an issue of the response time with regards to you as a customer. So the best thing I can advise with regards to that is ask around. There are probably a lot of individuals who have opened up CDS accounts. Ask people in the older generation who've probably had CDS accounts, and find out who are people generally preferring. Go out into Google and see if there's been any adverse information that has been mentioned about any brokers. On the flip side, find out if there's been any positive news that has been mentioned about any brokers. And finally, visit or give a call to the Capital Markets Authority, who are the regulators of the stockbrokers in the market, and find out from them if they have any reason why you should not open up an account with any specific broker, right? Because they are the regulators. If there's any adverse information that has been forwarded to them, they'll be in a position to tell you there's been this adverse information. But also on the flip side, they'll be able to verify that this is a bona fide registered stockbroker who you are free to deal with. We have given them a clean bill of health. With regards to CDS account opening requirements, once you have identified the broker that you want to work with, they will be in a position to tell you or give you all the documentation that you need to open up a CDS account.
Okay. If I may just chime in on that one, for the broker, we are all operating in like the digital era now. So it's also good to try and see if the broker is able to provide an online trading platform so that you eliminate, because time is money, time is very important, and you want to be able to take advantage of the market price movements as soon as you can. So if you're able to find a broker who's will provide you with an online trading platform, and you can access all the information, they can send you timely research on the counters that are there on the stock exchange, in the securities exchange, and then you're also able now to do the trading by yourself wherever you are, then I think that's also a plus for the broker. But yes, so CDS account opening, it is free. I think we need to add that as well. So there's no charge to opening a CDS account. It is quite fast. Once you've identified your broker, as Motho has said, then you present all the documentation to them. Most of them nowadays, you can even do it on soft. So they would send you the account opening forms, then you present it back to them with all the requirements, your ID, your KRA PIN, your photo, and they're able to process that and send you your CDS account details. And if you know you have the online platform, then you can start trading. So there is no cost to it, and it's actually eased up. So please do, if you don't have an account yet, please single out a broker and start your investment journey.
Thank you very much for that enhancement on advice, Linda. So we can move on. We were talking on this slide about our portfolio, and just to reiterate what we said, that is a basket of securities or a basket of assets that you hold for purposes of diversification. And diversification is important to mitigate risk, because risk is an aspect that we cannot avoid in life. But however, let me start by also then saying there that the biggest risk in life is to not do anything. So as Linda has just said, start your investment journey today as quickly as possible. The biggest risk is to sit on this information and do nothing about it, because at the end of the day, then you are losing the opportunities that are available to all of us. So the question is, now that we have decided to build a portfolio, what suits you as an individual? Like you heard from my intro, I help build tailor-made portfolios, and that is based on the realization that we do not have a one-size-fits-all solution for everybody. As much as we all want the generally same things in life, and we have generally the same requirements in terms of income from our portfolios, we are all in different stages of life. We all have different amounts of income. We are from different cultural backgrounds. So our approach to building a portfolio will differ from person to person. So there are certain aspects that we need to take into consideration as you're building up your portfolio as you, the individual. So one of the ones that you need to look at is your age. Your age can determine what kind of stocks you're deciding to invest in. Should you be a lot younger in your investment journey, like I believe a lot of you are at, you can afford to get into stocks that are more growth oriented, where the dividends will be slightly reduced at this stage, but the company is in a phase of growth. Like for instance, I talked about equity. So companies in a good phase of growth that will take a few years to 10 years plus, but you can afford to wait because you're younger in terms of age. But should you be nearing your retirement, your priorities in life could have changed from waiting for capital appreciation to a situation of where income is a lot more important to you. We have been through this phase of COVID, and if COVID should have taught us one thing, is that cash is king. There is no point in having assets that you say are worth a lot but cannot provide you any source of income or whatsoever, right? So age is an important factor from the point of what kind of income do you need at specific ages in your life, or even based on you may not be near retirement, but you may be at the stage in life where you're a family person and you have dependents who are going to university and who require significantly more finances from you. So you may need to adjust your portfolio from stocks that are longer term and growth in nature to those that are of more mature companies but give you more stable dividends. So that's one of the aspects that you need to look at, is your age. Another one is your risk tolerance. I talked about the fact that we are all from different backgrounds. It may be culturally, it may be from the family nuclear level. So our approach to investments will be different. There are those who feel that they can stomach a lot higher risk and may get into investments on the stock exchange of companies that are significantly more volatile, or industries that are significantly more volatile. So for instance, and to give an example of that, if you're investing in stocks in the agricultural sector, the risk is significantly higher dependent on what the weather is like in a particular year. We are just coming from a period of intensive drought. So that has had a big effect on agricultural output of some of the companies like the likes of Kakuzi and Williamson Tea and Sasini. So again, that risk could be a bit high. It could also be high in the positive from the point of view of the fact that these are companies that export majority of their produce. So if they do that, when the shilling has weakened and the dollar has strengthened, they are earning more shillings for each unit of dollar that they are receiving for their produce. So again, you can see a situation of where these are companies that have that are for those with a higher risk tolerance. And the flip side is that there are also those companies that you can invest in that are more mature, that deal in products where the risk or the change in variables to the company are not so intense on a year-on-year basis. If you're buying into the likes of BAT, those are fairly mature companies whose variations on a year-on-year basis in terms of their inputs, in terms of their markets, are significantly lower. Right? So based on your risk tolerance, you are then able to assess the companies listed on the stock exchange. You're able to assess fundamentals. You're able to understand the variables that determine the profitability of those companies, and you're able to make a decision on that. Your demands for income, again, can be related to your age, but they can also be related to not just your age, but other things that you are doing. So depending on what your demands for income are, you could be young, but in a job that is not very stable, as an example. So if you are making any investments, then you require a bit more income from your investments to fortify or to supplement the income that you're receiving from your job or from your employment, which is not very stable. Or you could be one who is in very stable income for a very long period of time and don't have specific needs for the returns of your investments in the short term, right? So you could afford to, again, go into those growth companies that may not be bringing you too much income in the interim short-term period, but are forecasted to grow well, to have good capital appreciation, and once they start nearing maturity stages, can then start giving you a lot more income. Religious inclinations is another factor in building the portfolio. You could be of the cultural and religious inclination that you do not consume alcohol, you do not consume any sort of tobacco-related products. So automatically, there may be sectors that you could have put in your portfolio that automatically are null and void to you, like the likes of the BATs and whatnot. You could have a religious background where you do not believe in investing in companies that charge interest for money loaned. So that could lock out the banking sector for you in terms of your portfolio. So those are just some of the things that you need to be aware of when you're building those portfolios. What are your particular set of religious inclinations or background that could affect the kind of portfolio you're looking to build? Sector availability is another one that can affect the kind of portfolio that you can build. Before Safaricom came into the market, there was no telecommunications sector in the stock exchange. Before the Fahari real estate rate and the lab trust rate came into the sector, there was no real estate investment trust that you could invest in. So your portfolio, if you're investing in the portfolio in the year 2005, vis-a-vis investing in your portfolio in the year 2023, vis-a-vis potentially investing in a portfolio in the year 2035, there may have been sectors that have been created by different companies from sectors that were not there in the market now coming in that will affect and determine the kind of portfolio composition that you can get into. Even in terms of sector availability, it's good to understand as an economy, where are we going and what sectors are being affected by where we are going. I'll give an example of the fact that there are certain sectors like the legacy newspaper publishing industry that are being rendered null and void by the disruption that has been brought by technology of today, right? So the sector availability is there, but what is the growth trajectory of the sector that you are looking to invest in? In our day and age today, when we're going electronic, when there is so much that we can do through the mobile phone, is telecommunications as a sector looking to be growing and have a better growth trajectory vis-a-vis the, like I said, the traditional media houses and the publishing industry. When we look at the likes of Scan Group, who predominantly and historically have been doing their advertising on TVs, have been doing their advertising on big billboards, has there been disruption with the advent of social media, and have advertising dollars gone towards social media that have affected that sector? So it is available, but what is its growth trajectory? So these are things that you all have to consider. So as you can see, there are a variety of factors that you need to consider when you're looking at composing your portfolio, and you need to make these decisions as an individual based on your understanding and based on what affects you as an individual. And one of the not final ones, because this is, like I said, this is just an opening as to what the considerations you need to make out there, but one of the very, very critical factors that you need to look at in this day and age, unfortunately, in Kenya, is corporate governance. I say unfortunately because the ideal situation should be that corporate governance, and what is corporate governance? Corporate governance is how are the internal affairs of the companies that you're invested in being run? Is there any conflict of interest between the people who are tasked with managing the company and the shareholder? Because the people who are tasked with managing the company have private companies who are making money off the listed company, which is not to the benefit of the shareholder. So corporate governance is a very crucial factor. And the unfortunate bit about it in our day and age today in Kenya is that there are a lot of companies that are listed on the Securities Exchange that have weak corporate governance. And because of that, in my opinion, renders them not be very good candidates to invest in. So please look at the corporate governance record. And Abojani, I think, talked about this when he talked about directors in companies. Have they been adversely mentioned in any cases here and there? If they have, then be quite wary about investing in such corporates. So please do a lot of due diligence, and due diligence and information you will get from a variety of sources. Speak to your stockbroker who you've chosen to invest through. Talk to ShareHub, talk to myself, talk to individuals out there. You'll be able to start getting an idea of which companies have got good and have a good track record with regards to corporate governance, and which entities don't have a very good track record with regards to corporate governance historically. On the good side, for instance, we have a lot of what we call our blue chips, the Safaricoms, the EABLs, the Jubilee Insurances, the Standard Chartered banks. Those ones who have had question marks with regards to corporate governance in our market, and a few examples of those have been the KPLCs, Kenya Airways, Mumias Sugar Company, the former NBK, East African Portland Cement, some that have collapsed like Athi River Mining. So the information again is out there. It just requires you to go out there, look for it, take the time to look for it, because all this requires is a bit of time, and you will start to get an understanding of which are the companies that are on solid footing with regards to corporate governance, which ones have had adverse mention. Was it very long time ago? Is it recently? And if it's very long time ago, have they taken steps to address the issues that were brought up against them, such that you now have the confidence to invest in them? So this is a very, very critical part of investing on the Securities Exchange and in terms of your portfolio composition in this day and age. Paris, I can open up the floor to 3 questions as we agreed.
Before we go to the questions, maybe you can add a bit and encourage us to download the ShareHub app. where we can be able to get at least more of the information with regards to the market. We have the price, the volume, the dividends, the earning per shares for the last 10 years for companies that are listed in the security exchange.
Asante for that.
We'll go to the questions. We have one major one. We'll take the rest when you're done with your presentation. When looking at the income statements, this is from Maureen. When looking at the income statements and balance sheets of companies, you get to buy stocks from profitable companies. However, the share price may be too high. For example, that for StanChart, which at 170, the company is doing well, but as an investor, will that be the best time to buy, or one will wait for the share price to go down, even if the company is doing well?
That's a good question. I think what is the most important thing is when you're looking at the financial statements will give you an indicator as to what the price should be. So for instance, we give the example of StanChart. Even if it has appreciated from 120 to 170 over the last 1 year, if we're looking at the financial statements, and the financial statements are telling us that the share should be priced at 250 shillings a share, it's okay even if it has appreciated to 170 to still buy into it, because there's still further headroom for appreciation based on the fundamentals that we have looked at. So what is important is, what are the fundamentals telling you the share price should be, and vis-a-vis what is the current share price. If the fundamentals are saying the share price should be significantly higher than the current price, even if the current price has appreciated over the last over the short term, and there is still room for appreciation, it is still okay to buy into it. So reading of fundamental statements is the most important thing, and getting an idea of what the share price based on those fundamentals is saying.
Thank you for that. I'll request you to continue the presentation. We'll take the questions at the end.
Okay, that is noted. So, volatility. What is the meaning of the term volatility? Volatility is the movement, the frequent and sometimes very rapid and high movement upwards or downwards of share prices. Now, we are encouraging you to start your investment journey, but it is also very important, as we encourage you to start your investment journey, to arm you with the proper mindset and understanding and expectation of what you will encounter in that journey. And the first thing that we can guarantee that you will encounter in that journey is a lot of volatility when it comes to investing in shares, right? Like I've told you, Safaricom over the last 1 year was trading at a high of about 44, 45. We are now at 18 shillings. I can assure you, there is nothing that has happened with the fundamentals of Safaricom over that last 1 year that have pushed that price down from 45 to 18. What has happened is a lot of factors that have nothing to do with the company itself that have caused the price to go down. And in a very brief nutshell, the war in Ukraine and COVID just before it, which has caused a lot of Western country governments to push up their interest rates, which has now caused a lot of money to flow from emerging markets, meaning that investors who had invested in emerging markets like Kenya sold off a lot of their shares to go and take advantage of increased interest rates in their home countries, meaning that there was a huge excess supply of shares in the market vis-a-vis demand, is what has, in a nutshell, caused a lot of these prices to come down. So Safaricom has been the hardest hit, because it has been the company on the securities exchange which has attracted and which continues to attract the largest amount of interest from foreign investors, right? And foreign investors contribute in terms of transaction value on the stock exchange here, they are the ones who are responsible for 65 to 75% of all trading on the Nairobi Securities Exchange. So that is volatility for you. The fact that you bought Safaricom even at 35 or 40 shillings, knowing that it is a solid company. You looked at the fundamentals, and the fundamentals supported a price of 35 or 40, but we are trading today at 18. So you are asking, were the fundamentals lying to us? And the answer is no, the fundamentals were not lying to us, but we have an understanding, because we have come through this Share Hub class, that share prices are not only a reflection of the fundamentals. Share prices are also a reflection of the general mood of the investors out there in the market. If we are in a bad mood today and we are all deciding to sell our shares, whether or not those companies are rock solid, the prices will go down. If we're in a very good mood and we all decide we are bringing all our resources to buy shares, even for those companies that do not have good, strong fundamentals, you know what? The prices of those shares will also go up. So it is an issue of understanding that volatility, ladies and gentlemen, we promise you, will be there. That is one thing you cannot avoid. And the issue is what happens when volatility is hitting you in a negative way. How do you react with it? How do you deal with it? What are you supposed to do? Again, let's give the example of Safaricom at IPO. IPO price was 5 shillings. Like I mentioned, 2 to 3 years later, the price had gone down to 2 shillings, or about 1 shilling and 90 cents. What should one have done? The fundamentals of Safaricom were only on an upward trajectory, but the share price was on a downward trajectory. So what do you do in a situation like that? If you have a good perspective on the market, and what is very important and how you deal with it is you buy more shares. Ladies and gentlemen, you buy shares as a rule. You buy shares of good, strong, solid companies when the share prices are going down. As a general rule, you buy as much as possible when the prices are going down, because what goes down will go up. And again, as another rule, and I talked about greed at the beginning and the avoidance of greed. When the prices are going up and you've looked at the fundamentals and they look overpriced, is when you sell, right? But volatility from a perspective of you've already bought some and the price has gone down, what do? The first thing that you do not do is panic and sell. Part of the reason why Safaricom price accelerated downwards after IPO is that, number one, people had taken quite a few loans to buy those shares, which is a very risky strategy, because there is no guarantee of price appreciation, but there is a guarantee that you must pay for the loan, right? So there is that mismatch of one is guaranteed, the other one that is paying for it is not guaranteed. So that's a situation you should generally try to avoid. So there was that issue, and that not understanding that when the price goes down, for as long as you understand the companies that you're invested in, you understand that this should be long-term investment, you understand the fundamentals are solid, and you should be buying more. But because there was lack of that understanding coupled with the panic, so more and more people sold and sold and sold, adding to more and more supply without the demand for it. And that's what continued to push the price down. Now, the unfortunate bit about Safaricom going down is that it is not the locals, but predominantly the foreign investors who accumulated those shares. So when those prices started going up, they are the people who benefited the most. We want to avoid that situation. ShareHub is trying to build a community of young investors who are taking ownership of the companies in their society that are making a profit, who are taking ownership of the companies whom they themselves are providing business to. So we want to be in a situation of where we are mature, young investors who are understanding the importance of ownership. I had someone mention speculation. I would and discourage speculation, because speculation is what a lot of times drives a lot of these prices down. Speculation is what causes a lot of the volatility that we can hopefully avoid. So we want to be long-term investors who are generating wealth by understanding that these are long-term investments. But should the prices go down, because there is no one single individual who has control over prices, should prices go down, we are well armed with the knowledge to understand if we are dealing with fundamentally solid companies, that we should be taking advantage of it as much as possible. And for you guys who are entry-level investors, there is no perfect opportunity than now where, as you are digesting market information and getting ready to start your investment journey at the Securities Exchange, start off with the ShareHub game called Wazito Shares Challenge, which is a perfect demonstrative simulation of what we are talking about in terms of market news coming in that provides the volatility, that provides the movement in share prices either up or down, and what you should be doing to take advantage of it. So ShareHub have provided a perfect environment through this simulation, through this game, Wazito Shares Challenge, for you to be able to take advantage of it and to start getting an understanding of volatility without risking your hard-earned real shillings through this virtual game, such that when you now step out into the market and you're looking to start your investment journey with your real pennies, you have a very good understanding and you have a good mindset when it comes to the issue of volatility. So as I wind down and then open up the session to a Q&A, ladies and gentlemen, you are young, look long-term. We have in society at the moment, we have the unfortunate issue of where everyone is looking to get rich quickly. It does not happen. You can get lucky once here or there, but you cannot consistently get rich quickly. So look at long-term outviews, look and embrace the issue of ownership. And when you're embracing the issue of ownership, what you are then also doing is you are getting an understanding of the businesses that you are invested in. When you get into a banking hall and you queue there for 2 hours because of the long lines, you have an understanding that all these people are contributing towards the profitability of that bank in whose shares you have bought, and with that profitability coming to the bank, it is coming to you as a shareholder of the bank. So please have a long-term view on these things. The greatest asset that you have is youth and the ability to accumulate over the long term. Please be consistent in your investments, whether it is through ShareHub, whether it is through the broker. Do not think that a one-time investment of 500 shillings, 1,000, 5,000 will be enough to make you millions. The most important thing is consistency. Every other month, every 2 months, every 3 months, depending on how your income comes to you, please set aside a sum for investments. It's called paying yourself first. Before you deal with everything else, please make sure you have that fund set aside for investments, that consistency. And it's never even the amount. Do not think that you do not have enough. Money and the amount that you have is never the issue. The issue is, do you have the right mindset and are you being consistent? If you have small amounts, it is more critical to be as consistent as possible. Again, we have said, look at accumulation. Long-term accumulation is what will make you the winner at the end of the day. You've all heard of the story of the tortoise and the hare. The hare was able to sprint, but got tired, and the tortoise came and passed it and got to the finish line before the hare. That is the issue of accumulation. That is the issue of consistency right there. So those are the things that are most important to you, and they will become very easy should you start to practice them at this early stage in your investment journey. And mindset, the most important thing. It doesn't matter how much money you have today. If you do not have a good and productive and positive mindset and correct mindset, anything you have can disappear, right? So have a good mindset. And once you have the good mindset, you will be shocked to find that even if your resources are not much, you start to attract the resources that will be available to you to be able to invest. So it is important to have the correct mindset. Again, the simulated games that ShareHub is providing are providing the perfect platform for you to get that correct, such that when you go out into the real world and you start your investment journey with whichever broker you've chosen, then you're in a position to have the correct mindset and you're able to hit the ground running, and you will not have a lot of the unfortunate experiences that many have had with the Securities Exchange, because the reality is that based on what you have seen, there are a lot of factors that one needs to take into consideration. It is not cut and dry. It is not completely black and white. It is fairly gray in areas here or there. But you know what? In the gray areas is where there's the greatest potential for return. And that is what we're looking at, a good return over the long term. So you have to be brave. And if you're brave, you will make it. Paris, I think I have come to the end, so I can open up the Q&A from there.
Thank you so much, Martha. That was very insightful. When they say there's no end to learning, I can attest to it because I've learned so much from you today. As we go to the Q&A section, I'd also like to engage our listeners. I'd like you to type maybe on the chat box on what has been your take home from Martha's presentation today and from Linda's presentation. From the Q&A, I'll take one for Linda. If I sell shares before dividends are paid, this is from Dominic, will I be paid? The second one is coming from Rosemary. Rosemary is asking, as on the ShareHubbers community, we were recently comparing share prices in the insurance sector, looking at current prices for the last 5 years. And they have dropped considerably. What is happening in that sector to cause that? The other question, we have two questions from Felix. There's one he'd posted before that I'd slated for this session. How easy and advisable is it to invest in offshore shares, i.e. Tesla shares, Microsoft? In the current recession, is it better to invest in local currency or dollars? And then the other question from him is, briefly inform us how the dollar shortage has a hand in the volatility. I'll repeat the questions from Felix. How easy and advisable is it to invest in offshore shares, for example, Tesla shares and Microsoft? Then is the current recession, in the current recession, is it better to invest in local currency or dollars? And his last question is, briefly inform us on how the dollar shortage has a hand on the volatility. Our last question is coming from Maureen. Kindly give an example of what fundamentals indicate what the share price should be. How are you able to know that a certain stock should be within a certain price range? I'll repeat again. Kindly give an example of what fundamentals indicate that the share price, what the share price should be. How are you able to know that a certain stock should be within a certain price? We'll begin with Linda, the first question.
Okay, I believe that's the one on dividends. If you'll be paid. Well, when dividends are issued, let me take an example of NCBA. They announced a final dividend, and they normally give dates when they do that. So there's something called the books closure date, which you need to be very aware of if you are a shareholder, if you have shareholding in that company. So for NCBA, their books closure date is on the 28th of April. Now, if you buy or if you hold NCBA shares between now and you don't sell between now and the 28th, then you're eligible to receive the dividends. But if you sell within the period, then you've basically sold your right to receive the dividend. And if you buy within this range between now and the 28th, then you will be eligible to receive the dividend. So that's a very important date for you to know. So you're eligible to receive the dividend based on if you've bought or you hold on to your shares up until the books closure date. If you buy after the books closure date, then you don't have the rights to receive the dividend unless you hold on up until the next dividend announcement date. I hope that answers that. So take note of the books closure. If you are a shareholder in any of the listed companies and they've announced dividends, please take note of the dates they have given, the books closure dates. If you also look on the NSE website on the price list, they normally write just next to the stock itself if it's trading CAM dividend or ex dividend. CAM dividend means, once you buy, you will get the dividends. Ex dividend means like it's already trading past the books closure date.
Linda, do you want to handle the one of the insurance companies?
Yes, I can do that. Yes, we've seen a decline in the insurance companies, the listed companies in the insurance sector. And I think for me, I can attribute this to one is a low uptake of insurance. I don't know if it's because we are Africans, we have trust issues when it comes to taking insurance. But yes, so there's a low uptake when it comes to insurance. I think even the penetration is about less than 5% here in Kenya. And then there's also, for the insurance companies themselves, there's a high insurance claims, which then eats into the profits. And now for such companies, especially for the listed ones, when you talk of dividends, the dividend comes from the money that the companies are making. So if there are more insurance claims coming in, and the companies as well don't really have the updated technologies to be able to verify on these insurance claims. So that also affects their operating costs and their profits now in the end. There's, I think there's also need for innovation in terms of like now we're in the technology era. So for most of these companies, they also are forced to invest more in improving their technologies, and that also is an expense to them. And I think for me, I think those are the main reasons we are seeing a dip in the for most of this insurance, the listed insurance companies. We would need now to look maybe individually to see now fundamentally, historically, and then projected forecasts to see how the insurance sector is going to be. But that one now is company specific. It's not really generally as an insurance sector, so we can't group them together as CAC and Britam are all going to perform the same, but it would now mean looking at them individually to see what are the fundamentals at Britam, what are the fundamentals at CAC. But there is a lot of potential on the insurance sector, especially when it comes to innovation, and we are seeing some of it coming up. And hopefully, at least once they adopt these innovations, then we'll see better results and stronger fundamentals coming from the insurance sector.
Okay, thank you for that, Linda. I will try and remember all the questions posed to me, and if none have been answered, then Paris, you can remind me. The issue of investing offshore and whether it is advisable. In my experience, well, they say charity begins at home. So in my experience, if there is access to some decent to good investments at home, always begin at home. Remember, the assumption that we're also making is that you are young, start-out investors who are just starting out on their journey. And because of that, number one, the amounts that you have to invest are significantly smaller. If that is the case, you always want to have the funds as close to you as possible. Because remember, when you're doing investments in foreign markets, you already lose out on the issue of foreign exchange. If I have my shillings and I'm turning them to dollars, and then I have an emergency here at home and I need to sell my shares and get back my shillings, that turning of shillings to dollars and dollars back into shillings, already there is a loss. Now, if you needed to do that very quickly after you had made the investment, you've not given the investment any time to give you some sort of a return. And ladies and gentlemen, it must be stressed that if you're looking to invest in shares, be prepared to invest for the long term as much as possible. We may see shares trading and we may see a report of shares of tens of millions of shares trading on a daily basis, but those are not necessarily shares that were bought yesterday that are being traded today. There may be shares that were bought 10 years ago. Remember, everyone has their different strategies when they're coming to trade on the stock exchange, right? So for me, it would not be advisable to start thinking about offshore, especially since we are fortunate enough in Africa to be in a country that has a relatively advanced financial system when you compare it to our sister countries, and have quite a few solid companies that we can invest in. Always begin at home first, have a solid footing, such that if you're putting money offshore, this is not the first point of call in terms of the money you may need should you have any sort of requirement for your funds, right? The next question was on how the dollar shortage is causing volatility. Remember what we said from the point of view was that the foreign investors are responsible for about 60 to 70% of trading on our stock exchange. Now, due to the dollar shortage that was in our markets, they panicked. They want to take their money abroad to take advantage of increased interest rates, either in the US or in Europe or in Japan. So because they want to go and take advantage of that, they are trying to sell, all foreign investors are trying to sell as much as possible, as quickly as possible, before their fellow foreign investors are able to do so, to be able to get the dollars to be able to go and take advantage out there. So they have caused a panic of sorts among foreign investors that has caused the volatility in the market. Furthermore, when a lot of these companies, if they are majority shareholders or big shareholders in a lot of the blue chips, like BAT, EABL, Safaricom, Standard Chartered Bank, when these companies are announcing the billions of shillings in dividends, a lot of those dividends are going back to their foreign markets, right? So again, that causes a lot of the volatility that you're seeing in our markets. So the dollar shortage has caused a panic amongst a lot of the foreigners, which has caused that now then a lot of volatility. Again, even from the locals who are looking to speculate and make money on the dollar have been selling their shilling denominated investments, shares being one of them. So I see, or I suspect there's a trajectory of the dollar going from 120 to 150. What do? I go and sell my Safaricom shares, get my shillings, and go and buy dollars, because I'm suspecting there's that shortage. The next person does that, and the next, and the next, and the next. So again, that panic and that speculation has been causing a lot of individuals to sell their assets that are priced in shillings, like the shares on our securities exchange, to go and buy dollars from a speculative perspective, causing a lot more of the volatility that we're talking about. Now, investment of local currency versus investing local currency versus foreign currency. Again, like I say, because we are fortunate enough to be in a relatively advanced market when you compare us to our neighbors, and because we are start-out investors who are starting out with small amounts, always, in my opinion, always start at home. A lot of these issues that we are seeing in terms of the foreign currency, fluctuations and whatnot, tend to be short-term in nature. the dollar or the shilling may not go back to where it was, which was maybe between 100 and 110, but it will not remain artificially high at the 140s and 150s indefinitely. Every few years, we have an economic cycle that causes a bit of a spike here and then. We had one in 2012 when the Kenya shilling to the US dollar depreciated very rapidly from about 90 to 107 in the space of a few months, and it was driven by this speculation that we are talking about, right? Now this one we know has been caused fundamentally by COVID and the Ukraine war, but has also been made worse by a lot of speculation and panic. But these are temporary situations that may last a few months to a year or 18 months, and eventually they will correct themselves. So as a start out investor, always look to start. You're blessed enough to be able to start in your local currency because you're in a market that has significant advancement. If we were in a Sudan, or we were having this conversation in a Somalia or the likes, the conversation may be a bit different. We may not have the luxury and the options of local investments, where now the only investments that may be viable at all are foreign ones. But luckily enough, we are in a society and we're in a country where we can have the privilege of talking about starting out with local investments. The final question on fundamentals that determine price. So I was hoping not to get into the technical aspects because Abojani had mentioned them to some extent, and the purpose of this specific class was to give one the general wisdom as to why to invest and what are some of the factors before we start drilling into the numbers. But just as an illustrative example, we have one ratio in the financial books called the price earnings ratio of a company, right? So if you look at an industry like the banking industry, and the price earnings ratio is simply a ratio of the price divided by the earnings per share of a company. So if you look at, and what one does is they look at the general averages for specific industries. I remember when we were being given our introduction, we were able to break down the specific industries, and we talked about agriculture, banking, commercial and services, energy and petroleum, and so on and so forth, insurance, and so on and so forth. So if you have an average, an industry average as an example, which is, and you get a price earnings ratio of 10, right? As an industry average, and you're looking at the specific fundamentals of a company within that same industry, and you get a price earnings ratio for a specific company coming in at 20, that may tell you that that company is potentially overvalued with respect to its peers in the industry. Again, on the flip side, if you do a price earnings ratio of a specific company and you get a price earnings ratio of 5, where the industry average is 10, then that may be an indicator that that company is potentially undervalued. However, you cannot just look at a price earnings ratio in isolation, because you have to ask yourself, are there other reasons that a price is artificially low when you're talking about a specific company? And I'll give examples. Companies that are majority or significantly owned by the government trade at lower price earnings ratios, and their prices do not appreciate as much as companies that are not specifically or majority controlled by government. Why is this? There is, to some extent, a mistrust about the manipulation of activities that government can get up to when it comes to specific companies. And it is by no accident when I talked about weak corporate governance affecting quite a few companies on the stock exchange, a lot of the companies that suffer weak corporate governance are those where there's a big, if not majority, shareholding by government. Unfortunately, at the moment, a lot of the companies that have good, strong corporate governance are those that have a good ownership by foreign investors, number one, or have very good diverse ownership by very many different individuals. So those ones that are predominantly owned by one individual or have a big shareholding with government, those tend to have a certain weaker corporate governance. And that weaker corporate governance will be reflected in the share price. So it is not automatic that because an industry average is 10 and the price earnings of a particular company is 5, that you should automatically go and buy it. No, look at some of the other factors that could be causing that, and you may stumble upon some. There may be situations of where, having looked at other fundamentals, things are still looking solid, and it could be an issue of the global factors that had caused a lot of foreign investors who had a lot of shareholding in that specific company and sold off, not because of any particular weakness in that company, but because they wanted to take advantage of increased interest rates abroad. So they sold off, which has pushed the price earnings ratio below the industry average. Then that makes a good company to invest in. So it can be the flip side of, it can be lower than industry average and not necessarily good, but it can be lower than industry average and be very good, depending on other factors that your due diligence has unearthed about that company. I hope I answered the 4 questions that were asked, Ferris.
Yes, you have very extensively, and I hope we have all been able to take up the information that we've been given today. That was a lot and very insightful. And I know for a fact that I have taken something, I have take-homes from your presentation, Motho. Thank you so much for honoring our invitation to come and speak to us today. And thank you for taking time off, and also for just all the wealth of information that you've given us today. Asante sana.
Thank you very much as well for having me. Again, congratulations. This is an excellent platform, and what you're doing to empower the youth to take advantage of opportunities and ownership is something that I think is very commendable. So good job, you guys. ShareHub.
Thank you. I'd also like to thank our other presenter, Linda. Thank you for your time. Thank you for your insight. And even as ShareHub, we want to say thank you for giving us this platform to be able to learn. And maybe you can just say a word or two before we close.
Yeah, as well. Thank you, Motho. I've also learned. As they say, you never stop learning. And this market is very dynamic. Every day we see new things. So it's always good to keep yourself updated. And as well, for me, I always say, once you've learned something, please share it with your family, your neighbors, your friends. If you're in university, please do at ShareHub. We as well go out to universities and talk and encourage the youth to invest and start investing early, because as Motho said, this investing is a journey, and you reap best results when you start it as early as you can. And yes, we look forward to seeing you in more of these webinars. We have them on a monthly basis, and ShareHub is here as well, so you can reach out to us. I think the team have shared all the contacts and information, our YouTube channel where you can get all the recordings and everything. So come, let us learn, let us engage even more, even after the webinar, and we'll be able to walk with you through this journey.
Thank you, Linda. So we've come to the close of our webinar, and I've seen 1 or 2 questions coming in late. Our team will note the questions and respond to you directly. And also just feel free to engage on the platforms that they've shared, so that you can also be able to learn more, play the games that you've been given, engage with the sectors where you've seen where we have the 10 years, the prices, the volumes, the dividends, the earnings per share for the last 10 years for the companies, and get more information on how you can start your investment journey. Thank you and have a lovely evening. You're free to leave the webinar. Asante.
Thank you, guys.
Asante, guys.
Thank you.